Hi, my name is Jim and I was retired. In this video, we will continue to look at the changes that I've made to my portfolio by buckets. In the last video, we looked at bucket 1, and in this video, we'll look at the changes made in bucket 2 and 3. Follow along as I discuss rebalancing buckets in a dizzy market. In a bear market, with high inflation and stagnating growth, it can be very hard to figure out how to continue to rebalance your portfolio. The market doesn't always cooperate. So what are you supposed to do? This video will go into some of the approach that I use with my buckets. Before I begin, please like and subscribe to this channel. If you like entertaining ideas from one educated consumer to another. I don't sell anything. I don't have a book. I don't have any initials after my name. So these are entertaining ideas. And if that idea appeals to you, please subscribe. I'm getting close to that 1,000 subscriber milestone, and I'd love to cross it soon. Now, in prior videos and playlists, I've described how I manage my retirement portfolio with a bucket strategy. I have 3 time buckets. Bucket 1 includes assets that will fund 3 years worth of expenses in cash and cash and equivalent assets. Bucket 2 has another 5 years worth of expenses and assets that produce income, and I can hold and manage the income flow from those assets. And in bucket 3, I have longer term equity assets. And with this strategy, I don't have to sell equity while they're down. I can wait up to 9 years before I must tap the assets in bucket 3. Now, my past videos have described how I use a spreadsheet to manage the asset allocations across those 3 time buckets, as well as 3 tax buckets. Taxable accounts in my bank and brokerage, tax deferred in my 401k and IRA accounts, and tax free in my Roth accounts, Roth 401k and Roth IRAs. So keeping all of your asset allocations across all of those buckets is complex, but you can do it with a spreadsheet. And I've shared that spreadsheet on my Google Sites. So take a look at it. Now let's look at what I've done this year to rebalance across those buckets in a very dizzy market. As of September 1st, here's where I stand with overall asset allocations in my 3 time buckets. Bucket 1 is all fixed income, cash and equivalents, safely stored here where I can tap them for the next 3 years. Bucket 2 is 24% equity, and the balance is fixed income, bond funds, income producing assets. And bucket 3 is 81% equity with some long-term bonds on top. It gives me an overall asset allocation of close to 50-50. And as I've explained before, my long-term investment plan is to move to a 60% equity, 40% fixed income as the market allows in the coming year or so. And I made this decision to go from something either age-based or 50-50 to a higher equity because I am now drawing a pension. Because my pension has started this year, and because I'm 5 years into my retirement, my risk appetite has changed. I am less vulnerable to the sequence of return risks now that I'm 5 years into my retirement. And with the pension income, I can afford to take a little bit more risk. So my strategy is to go up to 60-40 in my overall portfolio. And here's a refresher from the last video on where I stand with asset allocation within the 3 time buckets and my overall 3 time bucket pie chart. Briefly, in the tax bucket situation, tax-free with the Roth conversion I made within my 401k, I went from 10 to 12% here. Tax deferred went from 70 to 68, and taxable remains about 20%. And these are the asset allocations for the tax buckets. Now, one of the other things in my investment plan has been to reduce the overall net expense ratio in my portfolio. And I've been focusing on that for the last 5 years, getting rid of any of the high expense ratio mutual funds or investments and concentrating on particularly low-cost index funds. And as I described at the beginning of the year, I have 2 actively managed Vanguard funds that had been in my account. Vanguard Wellesley Income in my Bucket 2 and Vanguard Wellington in my Bucket 3. And both of them were the last 2 actively managed investments that I had and had considerably higher expense ratios than I want to pay. Here's a look at the overall picture in Bucket 2. And in here is where I've made the change, and I'll describe that in a minute. Overall, in the tax-deferred portion of Bucket 2, I have TIPS funds. I moved to TIPS funds last fall and into the early part of this year. At some point, I want to get out of TIPS funds, but right now, TIP funds are down, and I'm trying to wait a little bit to see if they'll recover before I redeploy these into other kinds of fixed income investments. In this portion of the tax-deferred area of Bucket 2 is the Vanguard Dividend Appreciation ETF, VIG, and that was my substitute for the Wellesley Income, along with the BIV ETF, which is the Intermediate Bond Fund from Vanguard. Now, I also have in my taxable account a TIPS fund, SWRSX. I didn't do anything with that. These 2 here were the substitutes for Wellesley Income. And how did I find those? In an earlier video, What's in Bucket 2, I went through the process of choosing which ETFs to replace my Wellesley Income. And it involved the portfolio visualizer. Now, briefly to recap from that earlier video, I looked at Bogglehead forums about what would be good substitutes for Wellesley Income and came up with some ideas of VIG and BIV. And so I used Portfolio Visualizer to see if that was a good idea. And I did it through a back test of the portfolio. And I used a month-to-month rebalancing quarterly and then entered the fund symbols here. And so in Portfolio 1, we'll look at 100%. Suppose one fund just has the Wellesley Income. And in the second one, the other one has these 2 ETFs in the same proportion as the Wellesley Income. And once you're sure both of these say 100%, you analyze the portfolios. And this shows you the CAGR, very close, standard deviation, very close, portfolio growth over the hypothetical analysis period is pretty close. A little bit, the ETFs were outpacing Wellesley Income. Now they're tracking pretty much the same. The more important thing is to look at the exposures. And in exposures, you see the net expense ratio is 0.23. I think in my earlier video it was 0.22, so it went up. And that now compares to a net expense ratio of 0.05 for the 2 ETFs together. Now in Bucket 3, I had Wellington. And truth be told, I had Wellington in an Admiral class, and its expense ratio was 0.16, which is pretty good, better than the 0.23, but still way too high for what I want. And as I said, Schwab had locked the account so that Admiral class I could hold or sell, but not add to the investment. So it was time for a change. So in doing the analysis, as you'll see in what's in Bucket 3 video earlier, I looked at comparing not only what was a good replacement for Wellington, but more importantly, what was a better fit with what was already in Bucket 3. And as you can see, a comparison between the Wellington Admiral and the VTI ETF, which is Vanguard's total market fund. And that's the one that I think I'll be moving a lot of Bucket 3 to this ETF as time goes on. And as you can see, CAGR is a little bit higher. There's no bond protection that Wellington has. The standard deviation is higher. But again, I then looked at this compared to what else is in my Bucket 3, which I'll get to in a minute. The more important thing was the exposure here, and look at the net expense ratio of 0.16 compared to 0.03. So here is a picture of my Bucket 3 overall after all of these changes through September. It includes a little complexity because Bucket 3 includes taxable, tax-deferred, and tax-free assets. But this chart shows you all of the investments in Bucket 3, including taxable accounts here at the bottom. And it starts here with these symbols here. There's AT&T and Pfizer that I've held for quite some time in my brokerage account. They pay dividends, and I plan to sell them over time as the market allows, but in the meantime, I'm collecting dividends, same as with this VYM pays dividends, and eventually I get rid of it. These two are spin-offs from previous funds, so I'm stuck with them too until I can sell them, maybe for a tax loss at some point. This one is a middle to small cap fund in my wife's brokerage account. She has a sliver of a real estate, which again, these are the things that make more sense to move to a Roth over time. And then this starts the tax deferred accounts. There's a bond fund, and then there's that bank annuity that we described in the other video on Bucket 3. And then some zero funds for international exposure, my wife's IRA, some international exposure in my IRA, international exposure in my 401k, a zero general total market fund in my wife's IRA, a dividend appreciation fund, mutual fund version in my IRA, VTI. The new addition to this is to move to a total market, then her total market zero fund, and then we go into the tax freeze. And again, we've got VTI, some equity exposure in my Roth 401k, some real estate exposure in my Roth IRA, real estate exposure in my Roth 401k, a little bit of cash that gets redeployed at some point here, and some small cap. Those are all the assets that we've got here. Now, the big changes here were this VTI to replace the Wellington. So as you can see in these two pie charts, the decision to sell Wellesley Income and Wellington made up 95% of what I've sold in 2022. You can see here is the Wellesley Income and here is the Wellington. And between the two of them, they make close to 95% of what I've sold. Now, if you look over here to what I've bought, you can see that VTI is a good chunk of it, and so is VIG in Bucket 2, and so is the BIV in Bucket 2. The rest are a little trading here and there, you'll see that I bought more than I sold, and that's because I was sitting on cash to be redeployed into buckets 1, 2, and 3 at the beginning of the year. So these two were really the biggest strategic changes that I've made in the portfolio. When do you do these changes? I was trying to stick to a rebalancing on the quarter. And what I did was I took all my transaction data from Quicken and I plotted it on this line bar chart here that shows purchases and sales of equity and bonds. And it's a little bit noisy. And in the background, I decided to put what did my Quicken portfolio look like over this period of time. And as you can see, it's been a really dizzy ride. So I had some changes that I made in the beginning of the year. Then I did them strategically throughout the first quarter. Did a little bit more at the end of the first quarter. I did some more strategic changes, and I did another set of changes about halfway through the year. And then I've done this change here the most recently, was to get rid of the Wellington and make the change. I wish I kind of bought these things over here as prices came down, but that's when I made the change. It's kind of difficult at times to figure out when to do it. Now you can stick to a quarterly schedule and then you're not accused of timing the market. But it's really a combination of looking at it quarterly and trying to decide to do that, but also paying attention to my portfolio by buckets spreadsheet. And I want to jump over to the sample data that I shared when I rolled that out to you folks, just as an example. It's not going to correlate with the data that you've seen here on my buckets this year, but let me look at this spreadsheet. This is the spreadsheet that's available on my Google Sites, which has dummy data that shows the approach of how I manage these buckets by pasting data from Quicken here and then taking a look at the allocations. And in here, it takes all that stuff and produces this chart here for overall asset allocation. And then it says, here's your current allocation and here's your target allocation, and comes up with a decision rule here of, well, if you want to get to this 50-50 and you're currently 47-52, you need to move these kinds of assets to rebalance. So I look at this for the allocations and I look at this for the time buckets. And again, on this sheet down here, you'll see this area and it shows if your annual expenses are this, then you need about this in your bucket 1, this in bucket 2, and this in bucket 3. And it takes what you currently have and makes these rules here that says if you really want to rebalance your time buckets, then you want to move about $13,000 into bucket 2, and it's going to come from mostly bucket 1 and some in bucket 3. And again, this is the sample data. This is not 2022 in Jim's world. Generally, I look at the tax buckets towards the end of the year to see if there's any room to do a Roth conversion within my tax bracket and within the income limitations for ACA marketplace premium tax credits. There are rules you want to live by. There are consequences and trade-offs. So you want to be able to time a Roth conversion that you know will fit in your overall financial plan. So I'll generally do that towards the end of the year, but with the market down and with the particular tax advantages of doing a in-plan 401k conversion to my 401k Roth accounts, I chose to do that in this summer, and I moved about $15,000 worth of assets, of which I'll only have to pay taxes on about $5,000. And because of that, I think I've got enough in my wiggle room to do that. I will look at the end of the year to see if I have any more margin for error in the tax return to see if I can make an IRA to Roth IRA conversion as well. I'll conclude with my standard warning. I have no initials after my name, so take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. And I'll see you next week.